Hello there, my name is Pavel Konecny and I'm the Chief Investment Officer at TriStar Trust. The Fed just raised interest rates by 0.25%. And I was thinking, what exactly does that mean? So I'm going to spend the next couple of minutes trying to explain what that means and what the impact it has on our everyday life and the impact it has on investment portfolio. So what does it mean? The Federal Reserve controls supply of money and they control what they call the target rate. And that target rate is a rate which the banks borrow money amongst themselves. By increasing that rate, that basically means that it's a little bit more expensive to borrow money. Why do they do that? As you know, we have been in a 6% plus inflation over the last couple of months, and the reason why is it's because the economy is doing really well, almost too well. And the Fed is charged with a mandate to target inflation about 2%. And by increasing the rates, it makes the borrowing cost, and that's what it means for everyday person, it makes it a little bit more expensive. That also means that they make a little bit less investment, and it just slows the economy down. Eventually what's going to happen, if it gets a little bit too far, then they turn it around and start lowering the rates to make sure the economy continues to do well. What does it mean for an everyday consumer? Well, basically what it means is that any short-term, and this is an important distinction, any short-term interest rate is most likely to go up. So that means that your money market account at your bank should probably increase as far as the interest rates are concerned. Any credit card debt will probably increase in cost. Any variable rate type loan will most likely increase in cost. And so all it does is it makes it a little bit more expensive to borrow money, therefore people don't spend as much money and the economy slows to a more appropriate levels. Now what does that mean for the investment portfolio? What it also means that there is what they call less liquidity in the market, which could mean that the growth that we have seen in the equities is going to slow. Now, at the beginning of the year, and we've addressed it in my previous comments, that has already been priced in. That means that the market has adjusted to this increase in interest rates, and quite frankly, we're expecting a few more this year. So it's already priced in. So I don't really have any concern as far as equity markets are concerned. What's important to note is that this increase in interest rates may have an impact on bonds, except the Fed only controls the short end of the yield curve, short-term interest rates, and those do not impact the cost or the value of bonds. Now, what impacts the value of bonds is long-term rates. And when you take a look at the long-term rates, they haven't really moved that much. So really, this increase has already been priced in. This increase may mean that we most likely not going to see a 25% increase in our equities, but it doesn't mean that the stock market can go up another 9% this year, and the bonds will actually play the role that we've talked about before, and that is protect your value of your portfolio.